Hello friends, what do we do if we need money? We go to the bank and take a loan from the bank. Similarly, if banks need money, they can also take loan from RBI for long term and short term. This is the reason why RBI is also called the banker of banks. Depending on the type of loan, RBI offers loan to these banks at different types of interest rates. One such long-term interest rate is bank rate. And similarly, one short-term interest rate is repo rate. Now it is obvious that the banks will charge their customers a higher interest rate than the interest rate at which they get the loan. And whether more customers will come to take the loan or less, it will depend on whether the bank is charging them a higher interest rate or lower interest rate. Because if the bank charges a higher interest rate, then less customers will be interested in the loan. And if the loan is available at a lower interest rate, then more people will be interested in taking the loan. So what is coming out from here is that whether more people will take loans in our economy or not, it will depend on the percentage at which RBI give loans to banks. Let us concentrate only on short-term loans for now. We saw that when banks take short-term loan from RBI, then the interest rate charged by RBI for it is repo rate. But its opposite case is where banks give short-term loan to RBI or rather park their surplus amount with RBI. In this case, RBI gives an interest to the banks. And this interest rate is called reverse repo rate. And the amazing thing is that whether it is reverse repo rate or repo rate, both these interest rates are determined by RBI itself. And through both these interest rates, RBI controls the liquidity of banks. Now two questions arise here. The first question is what this liquidity is. And the second question is how does RBI control this liquidity through reverse repo rate and repo rate. So let us first know what liquidity is. Actually, the liquidity of the bank depends on how much cash the bank has or how many such liquid assets are there which can be easily converted into cash. This is basically the same concept of liquid money and blocked money which we covered in the introductory video of monetary policy. You can watch this video in the economy playlist. So that was about liquidity. Let us now see how RBI controls the liquidity of banks through repo rate and reverse repo rate. Let us understand it with an example. Think what will happen if RBI decreases the repo rate and reverse repo rate. Decrease in repo rate means that banks will get loans at lower interest rates. In such a situation, all the banks would prefer to take maximum loans from RBI. And reduction in reverse repo rate means that banks will get less interest to park their surplus money with RBI. And in such a situation, no bank will want to park their money with RBI. So we can say that due to reduction in reverse repo rate and repo rate, the liquidity of banks will increase. That is, banks will have more money to give loans to their customers. And the exact opposite will happen when RBI increases the reverse repo rate and repo rate. Because if the reverse repo rate and repo rate are increased, then instead of taking loan from RBI, banks will try to park their surplus amount with RBI itself. In such a situation, their liquidity will reduce, and at the same time, their lending activities will also reduce. So we understood how RBI can increase or decrease the liquidity of banks by changing the repo rate and reverse repo rate. That is, it can adjust the liquidity. And that is why reverse repo rate and repo rate are called Liquidity Adjustment Facility, that is LAF. And this concept was introduced by RBI in the year 2000. And since then till today, it is a key element of the monetary policy framework of RBI. So now I can say that as a layman, you have understood everything you need to know about reverse repo rate and liquidity adjustment facility. But if you are preparing for UPSC, then this information is not enough for you. That is why we have to go into more depth of this concept. First of all, let's talk about repo rate. See, whenever a bank takes a loan from RBI for short term, then whatever amount of loan the bank requires, the same amount of bank securities has to be kept with the RBI as collateral. And for this, an agreement is prepared. It is clearly written in this agreement that RBI is promising the bank that it will buy back these securities on a predetermined date and predetermined price. That is repurchase. So actually we are calling it loan, but here we are talking about sale and purchase. And that is why this particular agreement is called repurchase agreement. Its short form is repo. And that is why the interest rate in this transaction is called repo rate. So if you look carefully here, what is happening in this transaction is that RBI is buying government securities from this bank at discounted price, and this discounted price is calculated based on repo rate. Let us understand this with an example. Suppose this bank is selling government securities worth 100 rupees to RBI. So will the bank get 100 rupees in the form of loan? No. Here RBI will give only that amount to this bank after deducting a discount in government securities. And what will be this discounted amount? It depends on the repo rate. For example, if we assume a repo rate of 4% and this money is being given for 1 day, then you will have to calculate how much interest will be for 1 day according to 4%. You will consider the discount and subtract the same value from 100. And because this is a repurchase agreement, it is obvious that the bank will have to return this amount. But while returning, the bank will return the entire amount of 100 rupees. All this is happening because whatever discount there is in this transaction is basically the government's profit, that is RBI's profit. We are able to see that the rate of interest that the bank has to pay to purchase these government securities is this repo rate. Hence, many times the repo rate is also called the rate of repurchase. So now you must have understood why the repo rate is called the rate of discount or the rate of repurchase. So as we said, repurchase agreement is called repo rate in short, and these agreements are generally made for overnight borrowings. That is to say, money is taken in these agreements and the very next day the money is returned. That is, when the banks borrow money from RBI for 24 hours, then this money is borrowed through repurchase agreement. Now your question may be that why will the banks need this money only for 24 hours? So here you should remember the concept of CRR and SLR. See, every 15 days the banks have to fulfill their CRR and SLR requirements and send the related report to RBI and tell that they are fulfilling the CRR and SLR requirements. That is why after every 15 days, if there is any shortage of money, then banks take that money from RBI at repo rate and showing everything correct in their reports, send this report to RBI. After 24 hours of sending that report, they return the money back to RBI. And in this way, the requirements of SLR and CRR are completely fulfilled. If banks will not do this and there is any discrepancy in the requirements of SLR and CRR, then they have to pay a huge fine for that. So to avoid that fine, money is borrowed at the repo rate. Let us now talk about some variations of repurchase agreement. Some variations of repurchase agreement are also available, such as term repo and long-term repo operations. When banks need short-term loan but for more than a day, in such a situation, banks can take loan on term repo from RBI. These loans are taken for 7 days, 14 days and 28 days. And this feature was introduced by RBI in the year 2013. After this, if we talk about long-term repo operation, then this is the purchase agreement which was launched by RBI in the year 2000. And these are also called LTRO, that is long-term repo operation. In this case, repurchase agreements are made for a period ranging from 1 year to 3 years. That is, this is the option through which banks can keep their government securities with RBI and take loan from RBI for a period ranging from 1 year to 3 years. But RBI has imposed some limits on the repo rate, term repos and LTROs related borrowings. In 2016, RBI had issued this guideline that any bank can borrow only 0.25% of its NDTL from RBI on repo rate. On top of that, if the bank wants, it can borrow up to 0.75% of its NDTL on term repo. This means that if the bank's NDTL is 2000 crores, then this bank can borrow 5 crore rupees at repo rate, and on top of that, another 15 crores can be taken at term repo. Now it comes to long-term repo operations, that is LTROs. For this, RBI has specifically created a pool of 1.5 lakh crores for all the banks. So if banks need more money and have to borrow for a long period, then they can do this borrowing under LTRO, that is long-term repo operations. So this is about those cases when banks need it for short term and they take loan from RBI. Let us now talk about its reverse case where banks give short-term loan to RBI. And for this, they charge reverse repo rate from RBI. Actually, banks use this option when they have surplus funds. Suppose banks have a lot of money and customers are not coming to take loans. In such a situation, it is important to invest the surplus fund of the bank at a place from where it can withdraw immediately. Because if a customer comes to the bank to take a loan, then the banks will need this money. But remember that whenever banks park their funds with RBI gives them government securities of that amount. Here, an agreement is made between the RBI and the bank where the bank promises that it will resell these government securities to the RBI on a predetermined date and at the predetermined price. So you can see that this is basically a resale agreement, and that is why this agreement is also called reverse repurchase agreement. According to this agreement, RBI sells these securities at a discounted price, and this discounted price is determined according to the reverse repo rate. So in today's video, we have covered repo rate, term repo, long-term repo operations, reverse repo rate, and liquidity adjustment facility. To cover Indian history and Indian economy in detail, follow Bookstawa playlist. Link is given in the description box. Thank you so much for watching and supporting Bookstawa.